Where is the real estate market headed? That's what I want to know, and you want to know. Well, we're going to deliver that today. Hey there, Christian Walsh, real estate agent with Wire Associates. Today is a special day. We got some special guests. I want to give you the heads up. We got Michelle in the background. She's out of town and she's tuning in the background to keep things clean and clear. So thank you for that, Michelle. I'm out of town, so it's not my usual setup. I'm bright red for some for whatever reason. Had tons of technical difficulties, but we are going to get through this, and I'm super excited. So, first person to bring in is a gentleman by the name of Rick Sharga. He's a founder of CJ Patrick Company. He is, and CJ Patrick Company is a market intelligence and business advisory firm, but it doesn't do justice to everything that Rick Sharga knows. So let's get Rick in here. Normally, Rick, I have a round of applause in my software, but since I'm out of town, I can't do that. So there's your applause. Thank you for being here. We really appreciate it. So Rick is an absolute wealth of knowledge, and we'll talk about some of the topics that he knows, but he is the man who knows everything about national economic data, foreclosures, housing market statistics, and just like this guy, who happens to be an educator, former home builder, has an amazing training course for real estate agent, actually several, and now a consumer directed course. Looks a little bit like me, about 6 inches taller, but it's still, I'm his son. That's my dad, Dennis Walsh. So Dennis is going to be here as well. So we're going to duke it out and discuss the housing market, although I don't think it'll be really much in the way of duking it out. I think we're really going to honestly have a lot of the same opinions on things. And we've got the chat open, so you guys can pipe in and chime in and ask any questions you have, make any bold predictions, give us your opinion. But thank you, gentlemen, both for being here. Really appreciate that. Absolutely. And it's certainly happy hour now or after this. So just to throw that in there, you guys can go enjoy your time.
And I wanted to throw a little more applause in for Rick. He didn't quite
get
what he deserves. He normally, I've been a big Rick fan for as long as I can remember. So it's always fun to hang out, brother.
You're a good man, Dennis.
All right. So Rick actually put together an amazing presentation for us that we can dive in, and we're going to pop in and out of it. So I'm going to bring that up now to get that started off. We're the first to see this. This thing's hot off the presses. Look at that, June 11th, 2025. So first things first, getting into we're not going to cover all of this. We're going to cover some of this. I don't want to take all of Rick Sharga's thunder. But Rick, what are you seeing in general in the U.S. economy right now?
I see a lot of headlines that tell us we're about to hit the iceberg, but the boat still seems to be afloat and doing reasonably well. You looked at the first chart there. We've seen the stock market, which really took a precipitous dump when the tariff talk started,
right?
But seems to have recovered nicely, and we're not at all-time highs at the moment, but we're pretty close in a couple of those stock indexes. I don't have a slide in here on the country's gross domestic product, the GDP. We did have a moderately negative first quarter by the slimmest of margins, but mostly that was because we had a whole bunch of companies stocking up on foreign supplies, hoping to avoid having to pay a tariff on them later. But as you look at all the other aspects of the economy, whether it's wage growth, job growth, unemployment, consumer confidence, everything's really pointing up right now.
Yeah. Job numbers remain strong. So there's no indicators with job numbers where they are and where unemployment is, as you say, there really are no indicators for a recession, despite, like you said, headlines continuing to beat that drum that potentially will have a recession. Is it possible
but to be fair, Christian?
Yes, sir.
We haven't had tariffs as high as the administration has proposed since, I believe, the 1920s. And every time we've tried to raise tariffs in the past, or other countries have tried to raise tariffs, two things have happened. We've had short-term unemployment, and we've had longer-term inflation hitting. And that's what caused a lot of economists, when these tariffs were first announced, to change their perspective in terms of whether or not we might see a recession. But if you look at all of the other underlying aspects, look, the U.S. economy, 2/3 of the U.S. economy is made up of consumer spending. So if you go to the next slide, you'll see that consumer spending continues to go up, and consumer confidence took a dive when all the recession talk started because of the tariff conversation. But in the last month, we've seen all of the consumer metrics, the sentiment survey, the expectation survey, inflation, jobs, you name it, tick back up. So they're coming back up. So a lot of the underlying metrics look solid. We have to get past the psychological barriers that have kind of inadvertently been put in place.
Well, let me ask you this, Rick, too. One of the things, some of the research I've been doing recently, so far it doesn't appear that anything relative to the tariffs in the way of prices has actually been passed on to consumers. And to your point, when you look at consumer spending and you look at the increase in consumer debt, like a bunch of drunken sailors still running out there having a blast.
Yeah. Consumer spending's at an all-time high. Consumer debt is now a little over $18 trillion. $18 trillion. A lot of money. All-time high. Delinquency rates are going up for a lot of consumer credit. Not quite to pre-pandemic levels, interestingly, but trending the wrong way. So it's not unusual that consumer sentiment would be a little bit down. But to your point, Dennis, if you look at inflation, a report came out this week on inflation. The CPI report came out at 2.4% annual inflation. Mm-hmm. That's not quite where the Fed wants it, but hey, that's within spitting distance of that 2% number that the Fed's been talking about. And look what wages are doing relative to inflation. Right. Coming in almost twice as high as those inflation numbers.
Which I think, that at least on some level, we always talk about affordability. I know you're going to go there and dig into that, but those increase in wages is helping us move a little closer towards the direction of affordability that we want. So I don't know how much measure.
Well, but my question is, what if the stock market is wrong? What if and consumer confidence is wrong? What if it's a form of irrational exuberance? What if the stock market really isn't factoring in the effects of these tariffs? I don't know what your thoughts are on that, gentlemen.
The stock market always overreacts to the upside and the downside. And we had the announcement from President Trump this week that they have the makings of a deal, trade deal with China, which is the one that had the market most worried.
Right.
If we get that thing put to bed, even with the tariffs being increased, I think the speculation is worse than the reality.
I think you're right.
And I think if the president and his team could get a little more consistent with messaging, a lot of the volatility and uncertainty would come out of the market.
Right. Well, I think that's, and again, we probably don't want to go down that road, but too far. But I think that's part of the strategy. Part of the plan is not having quite the clarity everybody would love as part of the negotiation process. So
I think the devil's advocate would say not having a plan is the plan. But again, we won't go too far. Let's actually, I want to go to a question we have here because this is a great question and it's maybe a little premature, but I still think it's a great question. Johnny Cash is asking, is it still worth it to buy multifamily buildings, 20 and 40 unit in Burbank or LA? And I'm going to give my opinion because this is my wheelhouse. And then I want you guys to give your thoughts. But short answer is, this is actually separate questions. The separate questions are, is it worth it to buy multifamily? And then the next question is it worth it to buy multifamily in Burbank and LA? So I do think it's worth it to buy multifamily personally, but not in Burbank or LA. Any areas where we're seeing rent control. So LA City, for example, most likely this building, unless it's newer construction, it's going to fall under their RSO, the rent stabilization ordinance. If it's newer construction, it could fall under their just cause ordinance. Mm-hmm. So anywhere you see a continued tightening in a reduction in landlord rights and a reduction in how much a landlord can charge. If a building is under the rent stabilization ordinance, you're going to be able to charge a 3% annual increase. And this is after we had during COVID a 4-year pause in any increases. Is a 3% annual increase going to be enough to keep up? No. And they're also currently working to potentially reduce that 3% increase because that's too high for some renters. So we're going to have to do a 2% or less increase. So this is a long answer to a short question. Yes, multifamily in general, over the long term, if you're buying it in the right place, will be a good play. There will always be renters. In fact, we're probably going to have a larger pool of renters going forward based on economic conditions. I want to hear Rick's opinion on that. But you just need to be buying, you need to own the building somewhere where the landlord is at least going to be able to increase rents to cover their costs. All right, I'll pass the mic. What do you have to say on that, Rick? Are you good with multifamily?
I'm not as optimistic about multifamily short term as you are, only because we've seen a huge burst of supply hit the market in the last 12 to 18 months. We've had an almost record number of new apartment units come online, something like 1 million in the last 18 months. And so there are some issues there. I think your counsel about buying a rental property in Los Angeles or San Francisco, or frankly, I'd be a little bit concerned about most of California, just because it is so very unfriendly to landlords, is really good advice. The flip side of that, if you look at things from a short-term opportunistic point of view, there's probably going to be accelerated demand in the region for a while, given that we lost 10,000 properties in the recent fires, and we've only had 50 building permits issued since then.
That's insane. So
these people need somewhere to live, and if you can get the property at the right price, so if it's a discounted price from current market rates because somebody has to unload it, I might take a long look at that, even though I'm not overall high on rentals in LA or California.
Yeah, before I have you pop in there, Danuch. So Johnny Cash clarifies Burbank is 8.9%. The reason that it's 8.9% for the rental increase annual amount is because they don't have a local rent stabilization ordinance. And that is the Tenant Protection Act limit, 8.9%. That's going to adjust in July. It's going to be 8%. But the other side of it is when you're surrounded in basically by LA City, West Hollywood, when you're surrounded by other areas where those properties are protected, you do have to worry in the long run that your unprotected area will ultimately fall into that as well. It's almost like the weeds in your neighbor's yard, like they could eventually not to say it rent control is a weed, but the weeds have a way of moving into your
You've
yard.
seen my neighbor's yard, apparently. So
yeah. What do you think there, Danuch? What are your thoughts on?
Well, I think I agree with both of you in the sense that, number one, we've seen just nationwide, as Rick said, we've seen a big increase in the production of multifamily. We've seen a lot more new construction, both multifamily and single family, coming to the market, and affordability has been an issue there. At the same time, we've seen an uptick in resale properties, which is just more inventory and more competition. I think, to your point, Christian, it's just market by market. We didn't have all this growth in the multifamily production for no reason. There was a lot of real bright, smart folks out there who analyzed various markets and did this. And I think that's going to continue. And especially when we move forward, the concern about wage increase, income as it relates to building costs and all those things, as you mentioned, Christian, I think we're become more of a nation of renters as far as the eye can see here for some time. So it's just market by market. I'm sure there's markets out there. Rick could probably, with his access to data, could probably zero in very quickly to markets that are more balanced, and that investment in rental properties, whether single family or multifamily, would be a wise move.
That's it, Rick. You just created a new product type here. You can hire Rick for advising on where you should buy your properties. And let's even break this down a little bit more. So 20 to 40 units, that's a good mix size at the right cap rate. But I might tell you to stick with buildings that are 15 or smaller, because once you get to 16 in California, you have an on-site property manager. So one of your units is going to be occupied by an on-site manager. 15 or smaller, you don't have that. You won't have the rent reporting guidelines AB 2747, I believe is what that is, if it's a 15 unit or smaller. And then I'd even say, again, back to what Rick said about demand, like if you could get some houses, condos, things like that, but be careful with condos because those could be rent stabilized as well. But it's smaller properties like that. Those like a portfolio of single family homes to me is worth a lot more than it ever was in the past, as we've seen companies buy those up. So that's what I would say is maybe stick with that unless you get your 20 plus unit at a better cap rate. Johnny summed it up well. Related to the rent control kind of spreading. If you're surrounded by desert, even if you're in the oasis, the desert always tends to win. That's a good way to put it, Johnny. Yeah.
That's good. Rick, I have a quick question for you. As you're crunching numbers, and I don't know how much analysis you do, on the rental market specifically, but do you also look at short-term rentals? Markets that have prime locations, properties that would fall into short-term rentals as opposed to long-term rental, and watching those trends.
I wish I could, Dennis, but the truth is there's no really good publicly available data on those short-term rentals.
Gotcha.
And the companies that those landlords work with keep all those numbers very close to the vest. So it's almost impossible to get a good read on what's going on in that market.
Okay.
You triangulate based on what you're seeing in areas you suspect have a lot of short-term rentals, but no, I don't pretend to be an expert on that category.
That'd be a home run. That'd be a home run if you could, find some sneaky way, find some data.
Well, I'm actually finishing up a report on rental properties in general.
Yeah.
And there are roughly 18 million single-family homes and townhouses that are rented out. And we know that some percentage of those are Airbnbs or Verbos or something like that.
Yep.
But it's just about impossible to tell which ones.
Okay.
So and you even looking at data to analyze these properties, you have to assume they're rentals because there's nothing in the public record that says rental versus a home that's occupied by somebody who's not renting. So what you do is you look for non-owner occupied properties. You look for properties that have been held by somebody who's not living there for at least a year because they're not likely to be a flip if it's that long. So you're in real estate data, mortgage data is some of the hairiest, fuzziest, unclean data you could possibly imagine.
I concur.
You need to really practice the black arts to be able to analyze this stuff.
I concur. Right. Trying to put together marketing pieces. I used to target non-owner occupied properties, and it is just dirty data. Not dirty in a bad way. Just you can't penetrate it. And short-term rentals, they're PD. That's what we call. My dad. The kids call him PD, which stands for Papa Den. So you'll hear me call him PD. So PD. Short-term rentals, the challenge right now is people were underwriting them at crazy numbers when they would go into it. They were inexperienced investors. So a lot of inexperienced investors are getting their hands slapped and they're not doing as well. And then the other big thing is cities are outlawing them. Even cities that are like Costa Mesa, which Costa Mesa in Orange County is not like a major, like you wouldn't look at it as a travel destination. It's not showing up in any Costco travel packages. Let's put it that way. So Costa Mesa said, hey, look, we're not going to have any short-term rentals, and we're going to set up a permitting process. Unless there's a permitting process like Newport Beach, Laguna Beach, certain areas have, the permitting, cities are shutting them down. And then just to make this even more convoluted, technically, if it's rented for 30 days or longer, it's not a short-term rental and doesn't need to be have any oversight from the city. So that would be another layer we really couldn't.
I remember we went down this road, not to sideline much here, but I remember we down this road. We had some folks coming to us. They had some form of data, wanted to start to do some analysis market by market. And that really was the sticking point. What we were talking about was creating a branded experience for, a package of premium rental properties. But that was the problem, as Christian indicated. You never know. You make your investment, you've got your wheels turning, and suddenly a new ordinance comes in and you're shut down. So, and the value's gone.
All right. So Johnny Cash is very loquacious. He has a lot to say, so I don't want to ignore him because I happen to like this question.
I
So
like
he
it too.
understands the point about people owning and buying multifamily in the area in LA. And I mean, it's fair to say, like, hey, every single one of these properties right now has an owner. And I'll circle back on that in a second. If you did do LA County, it was an RSO building, what would be your minimum requirements? And we can expand this. This isn't about LA. This is about any, because we're talking national too today. It's basically anywhere there's rent control across the nation. And Rick said this is if you get it at the right number, a rent stabilized property makes sense. But what's that right number? And you have to be crazy aggressive in underwriting it. And I mean, assume no rent increases. Assume it needs major work that needs to be done. A lot of the rent control ordinances, if you have to do major work, you're going to go ahead and you're going to have to relocate those renters, pay for them to be relocated, and then when they move back in, you're going to continue to charge them the same rent as before. So it doesn't pencil. It's not like you can go ahead and do a bunch of upgrades and charge a bunch more rent. So it doesn't pencil. So you have to factor that in. And there's going to be a cap rate. There's going to be a number where it does make sense to buy that building. Now, in California, where we've had our butts kicked for rent control buildings, is Prop 19. And Prop 19 states that no longer are the property tax values for a building that you inherited are protected and stay at the old rate. They must be reassessed. And when the county reassesses, they may not reassess a realistic number. I know it's shocking that in some cases the county would reassess at a crazy high number. And I've seen it happen where I had a property in Pasadena where I listed it for the son who inherited it. The renters were paying $800 each. He couldn't increase the rents. He was reassessed at $1 million, even though the property was a tear down essentially. And we ultimately sold it at $750,000. It wasn't because I'm a lousy agent. I'm a good agent. Trust me, I can get a job done. I know how to position and sell these properties. But he had been reassessed with a property tax bill of $1 million. So that's another issue that we have with rent stabilized properties. And that's actually a bigger issue across the nation because most states aren't like California where property taxes stay low. Most property taxes continue to go up. Rick, talk about property taxes and what you're seeing in some areas. That's been a problem for folks, hasn't it?
Well, we in California, we all probably have friends or family that have moved to Texas,
right?
Because they thought they'd do much better in taxes, and then they got their first property tax bill, and their heads exploded. We're about middle of the road in terms of our tax rate. California is, but that's offset by property prices that are crazy.
Absolutely.
Median sale price of a home in Southern California last month was $875,000. In Orange County, it was 1.2 million. In LA County, it was up over 750. So that tax basis goes up against a fairly high number. And to your point, Christian, not surprising to see a county assessor's office decide your property is worth a little more than you think it is. And the other thing, so property taxes aside, the other thing to think about in California, particularly right now, is you're talking about a rent controlled property. So you have a fixed rate, you're not going to be able to exceed in the long run. Your property taxes are going to go up over time because your property value is going to go up over time. The other thing that's going to go up that you can't control is your homeowners, your hazard insurance.
I was just going to.
Allstate or State Farm, one of the two, just requested a 30% annual increase because of what happened in the Palisades and Altadena fires. I can tell you as a homeowner, my insurance costs right now are twice what they were 2 years ago.
Right.
Because of the quote unquote risk factors involved in owning a home. So if you're factoring all of this into your equation and the math still works, great. There are always buying opportunities in really every market. But what I've been telling people, and this is really remarkably unsophisticated, common sense kind of wisdom, if you will, look for markets where population is growing,
Right.
Where jobs are growing and where wages are growing. And
Yep.
if you find a market where all three of those things is true, you're going to have a good real estate market for
That's
both owner-occupied properties and rental properties.
Right.
If you see a market where values are going down, population is going down, wages aren't growing, and jobs aren't growing, approach it with extreme caution, because you're likely to buy at the wrong price and have a hard time getting out.
You know, Rick, that right there, that little, like you say, unsophisticated analysis, that's been the story as long as I can remember. I remember, teaching our courses on new home sales and the market research, and as far back as I can remember, we talked about job growth, right? Wage growth, and then of course you measure your competitive factors, right? You study your target market, you look at the availability, demand, those kinds of things, but fundamentals that it will never change, I think.
You guys, we got to give it a sexier name. We got to make it sound more sophisticated. You can't just make it sound so basic.
We got to give we do have to give it a fancy name. Call it the something factor, right?
It's the Rick Sharga, Dennis Walsh factor, and that'll wow them. Okay, so in all seriousness, you guys have been through a few real estate cycles, and I mean this as a compliment. You bring wisdom to the table. So what I want to hear.
Really pain and agony, Chris. I mean,
well, yeah. So there's people watching this right now. People who are going to watch this who were born like around the global financial crisis, which is crazy to me. And like my oldest daughter, the reason I'm out of town, my oldest daughter is graduating college. She's 21. And so she has no idea what happened during the global financial crisis. And that's when I started selling real estate. So I want to hear just a quick version of what it was like way back when. Give us some of those stories. I know.
I was hoping Rick could show us some more pretty pictures, but that's,
we will. I promise. We'll get to more slides. But no, honestly, I think there's value in this because people don't remember what it was like. Like I remember the global financial crisis, but I don't know what it was like in the 80s because I was a kid. I don't know what it was like.
Let me just share just a few thoughts with you.
Yeah.
Rick will remember when there was a crisis that hit the savings and loan industry that essentially, new regulations and so on that completely changed the game. Mm-hmm. So we had a world that worked for us, and I'm talking about small builders, folks in the world of construction. We had relationships with lenders at savings and loans. And here I was in my 20s, and I was designing and building custom homes back then. But even then, I had a strong enough reputation. I had proven my ability to run my business and generate profits and so on that I could go to my savings loan and on a signature, as long as I had a signed contract on a deal. And even beyond that, I could do 3-4 spec homes. And my bankers, they would trust us. That's the way banking was done back then. We weren't filling out applications or anything. We went to lunch. We talked about what we had going, and off we went. And I'll never forget when overnight the phone rings and say, "Hey, we need all that money back now, right? Need everything paid." And it was just government regulations. Everybody was now under a scrutiny to try to, number one, to try to keep their operations going. Number two, to keep out of jail, because, and there were quite a few of these fly-by-night bankers that went to jail at that time. Roughly a third of the construction industry went out of business because just funds weren't available. And of course, at that time, suddenly the same thing across the board for the availability of mortgages, financing tightened up. And it was just some brutal times. And we've seen those ups and downs before. Of course, the Great Recession hit, and that was something as bad or worse than anything we've ever seen, right? I always describe it as like somebody flipped a switch in the world of real estate. The business of real estate was suddenly shut down and changed. And I know Rick, and he'll tell his story. Rick jumped into the world of REOs and, analyzing that and looking for opportunity there. We reinvented ourselves. You remember we put a partnership together with Lowe's Home Improvement. We created our Rebuild USA program. We tried to put wind beneath the wings of the FHA 203K renovation loan program. And the point is, what we've had to do time and time again, and it's coming back around to what you were saying, Christian, many young people, they've never seen markets like that. Many young people have seen a few ups and downs and maybe, some good order taking years. And wow, this isn't that tough a business. We literally had to pick ourselves up. Our world shut down as we knew it. We had to reinvent ourselves, right? And we looked at that and we said, what we're going to do is we're going to take a little known loan program, the FHA loan program. We're going to take the reality that Rick and his data is showing all these foreclosures coming through and tracking. And while investors were gobbling that up, if you remember one of our close friends, Chris, and one of your friends, Rick, built like a $6 billion investment fund around all those REO properties. But we said, here's an opportunity for the average American to own a home if they knew how to take advantage of this loan program, right? So I guess the point is here, we've seen a lot of changes. We've had to pick ourselves up by our bootstraps, reinvent ourselves time and time again. So we're always concerned when these things happen, but we always believe that one way or another, there's going to be challenges, bring new opportunities. We're going to take our talents and our experience. We're going to position ourselves. There's always a need for housing, no matter what it looks like.
Yeah.
And we just go from
Rick,
there. So
Yeah,
Rick, add to that. I want to hear what happened to you and what was going on, and then we're going to pull some additional morals out of this as well. But tell us what you experienced.
Well, your dad's right. There's about 350 million people in the U.S., and most of them prefer to live indoors. So there's always a need for shelter. I didn't get involved in real estate. My background was mostly technology marketing for a long time. I got involved in real estate right around 1998, 99.
Bet you regret that, but you're probably regretting that.
Actually, it's been a great ride. But I got to see the market go through its first period of, as you said earlier, irrational exuberance.
Right.
That probably peaked around 2005, 2006.
Mm-hmm.
And I was one of the people that happened to be at a company where we got an early signal that there was a bunch of foreclosure coming down the road.
Remember.
And within the industry, I actually became vilified for a few years.
Wow.
Well, because
you're a nice guy. You're a nice guy.
I'm an incredibly nice guy. I had a boss who used to refer to me as Mother Teresa because he didn't like the deals I would cut with their business partners. But the fact of the matter was that the mortgage industry certainly didn't want anybody out publicizing the fact that there was a problem brewing.
Exactly.
Particularly a problem that had been largely precipitated by bad actions on the part of people in the mortgage industry.
Right?
There was a story I read here in Orange County about a woman who was being foreclosed on for 8 properties in Santa Ana. And that was a bad enough story until you read into it further and found out her full-time job was she was a cleaning lady. She was making about $35,000 a year. And somebody decided it was a good idea to give her 8 separate mortgages on investment properties.
Oh my God.
And when the market turned, needless to say, things didn't go well for her. But this was going on all across the country. Yeah. And one of the things I want to hammer home to people watching this, listening to this, is that this is not 2008 all over again.
Right.
So we had a very unique and hopefully unrepeatable set of circumstances. I've always said our industry is really good at learning from past mistakes,
right,
but remarkably creative about coming up with new mistakes to make. But the mistakes last time were really bad loans to underqualified borrowers.
Exactly.
On overpriced homes. It was a toxic mix. We were giving people negative amortization loans. And for people who don't know what that is, you're actually getting a mortgage where you immediately are underwater on your equity. And it's a great tool for a professional investor to use for a temporary purchase.
Right.
But not a good thing to give your average home buyer. And we saw a lot of that nonsense. But we also had an oversupply of homes. Dennis, you know that on the new home side. But there were about a 13-month supply of homes available when the market crashed.
Right.
Normal market is somewhere between 4 and 6 months.
Sure.
So there were more properties than we could possibly sell. The lenders stopped lending because all of a sudden they saw this wave of default coming and they needed to get reserves up.
Right.
Then we had all the foreclosures. There were 10 million foreclosures in a several year period. And so now the inventory on the market was competing with bank-owned property sales and auction sales. And so prices plummeted. I will tell you this. I need a hobby, and you'll know why in a second. I looked at the last 100 years of home prices.
Wow.
There was only once when prices fell and stuck at
Mhm.
20% below where they'd been.
Right.
That was in 2008 during the
Right.
Great Recession.
Right.
We had a record number of foreclosures. We had property values fall. It took 3 or 4 or 5 years to get back to where they were prior to the crash. None of those conditions are in place this time.
Right. Right.
What I will say, though, and I'm very cognizant of this is the worst period I can think of to be a first-time buyer.
Yes.
Yeah.
Affordability is, according to the Atlanta Federal Reserve, the worst it's been in at least 20 years, maybe twice that long.
I believe it.
I bought my first home back in the 80s with a mortgage rate that was almost 20%.
Sure. Yeah, I was at 18%. Yeah.
Right. But the home prices were more rational compared to what people were making. So
Exactly.
we normally would have had home price appreciation and mortgage rates bouncing around, but then COVID hit.
Right.
And the Federal Reserve went to a zero interest rate policy, which drove mortgage rates down to 2.5%, 3%, which pulled everybody into the market trying to take advantage of these
Right.
low rates. We had a supply and demand imbalance, which drove prices up, but it's okay because you could still afford it with a 2% mortgage. And then
Yeah.
the Fed shifted gears and suddenly mortgage rates doubled in mid 2022.
Yeah.
The only time in history when mortgage rates doubled in a calendar year. And so suddenly that $400,000 house you were looking at, you could no longer afford. You had to look at a $200,000 house, but there were none.
Right. Right.
So we're looking at a market where the average age of a first-time home buyer today is 38.
Yeah. It ran about 31, 32 years old for
For
many
a long time.
Right. Right.
Yep. So people are unable to get into the market early enough because there's nothing they can
Right.
afford to buy. Plus, the millennials took longer to really get their first real job
Sure.
because they came into the market during that last recession. They got married later. They had kids later. All those inflection
Well,
points.
and then these college loans exacerbate their
Well,
ability.
there's only $1.6 trillion in student loans, Dennis. I don't know what you're talking about.
Oh my God.
Exactly.
And I forget the number, but it's something like 43 million people with a loan
Yeah.
that they have to pay. And it's so, yeah, home ownership rates are pretty low among people with that kind of student loan debt.
I wanted to build real quick, just kind of going back to what you talked about, 2006, 2007, all this exuberance, all this buying. Everybody saw everybody's friend and brother
Yep.
Buying investment properties.
Yep.
I knew a doctor who he went in and he bought 10 different properties. He probably couldn't afford one of them as an investment property. But what happened at the time, and you'll probably remember this, and I know, Christian, we've talked about this, you could go to any of the builders up here, building up in Newport Coast and building all these beautiful homes in these subdivisions. All you had to put down was $10,000. And that was your home, and then you had to be ready to close. And then there was, during that window, all you had to do was fog a mirror to be able to get a loan. And they would write up a loan with your first mortgage and the second mortgage to cover the down payment, right? So you get your $10,000 back. So what was happening is, a couple of friends would go in and say, hey, let's put together $50,000, $60,000. Let's tie up a bunch of homes. Their idea is as soon as the home's done, they're going to go ahead and just flip it, right? Flip it or flip the contract to someone else. Well, all of a sudden, right, the world changes. And here's like your woman with the 8 mortgages, right? You've got all these people with all these homes imagining that they're going to be able to flip them and sell them at a profit. It was insanity. But Christian and I remember talking about that. And to your point, Christian, about having this long-term experience. Do you remember the conversations we had? We were surrounded by people making these investments, buying these homes, all these stories of the people whose timing was such they did come out the other side and make some profit. The homes in one subdivision, the first few streets would be selling at a price here. By the time that subdivision was built out, everything was doubled. So everybody won a home run. But I remember saying to Christian, listen, there's no way it's going to sustain. It can't sustain itself. And so we watched how many other people went down that road and lost all those properties.
But what I want to emphasize is it's important for anybody looking at today's market conditions not to be sitting back waiting for that 20-30% price crash.
Right.
Yeah.
I saw a report today that there are now 11 states. This is from Altos Research. There are now 11 states where sale prices are lower today than they were a year ago.
Okay.
But you're talking about prices that are off by 1%,
right.
2%.
Right.
So it's on the margins. It's helpful for people trying to afford a home. But the only way you have a 20 or 30% price crash is if people have to sell their homes.
That's right.
Nobody's going to willingly take a 20 or 30% haircut unless they absolutely have to. So the more likely scenario, and I've been saying this for a few years, and people are getting tired of hearing it, so I apologize. But the more likely scenario is because we went through that whipsaw with low mortgage rates, soaring home prices, followed by soaring mortgage rates, and everything got stuck. It felt to me like it was going to be a 3 to 5 year period where things just got sluggish,
right?
Where there weren't a lot of home sales, relatively speaking. Prices didn't go up or down very much, maybe down a little bit. And it was going to take a few years for the market to reset. And what I'm seeing today feels very much like we're in year 3 of that 3 to 5 year reset period.
Interesting.
And I think we wind up kind of being stuck in this 4-ish million existing home sales a year. And I believe by the end of this year, national home prices will be flat or even marginally lower than they were a year ago. So it's just going to take a while to get out.
Yeah, another thing I'd like to throw in here, just for the heck of it, is just as you look at new homes, right? Home builders as opposed to used homes, the resales. And we've had a pickup, of course, in resales. We've also had the builders working really hard for years to increase their production, which is evidenced now by quite a bit of inventory out there. But the thing to keep in mind is builders, their way they put food on the table and keep the lights on is building and selling. They've got to keep the wheels turning. So they're going to continue to adapt their product, and they can play with their margins and so on. And they're willing to do that more so than some individual who's hoping to hit a big home run on their own home. You know, a seller of a used home can say, you know what, I'm not going to sell. I'll come back off the market. The builders can't. So what we've seen is we reached a point maybe a couple of years back where the premium for a new home over an existing home, as much apples to apples as you could get, had reached a high of about 30%. And that's a big premium to pay for a new home. Of course, you're getting a new home and full warranties and all the advantages we know. But that has probably dropped at about half right now. And what's happening is, of course, the builders have gotten more creative in producing a home that appeals to someone, controlling their costs, right? Keeping things under control. They're buying down the mortgage rates. So that's a key factor. So a lot of people maybe haven't thought that through. Look at what that does to affordability. And if you can get in and take advantage of that. And then right now, the latest number I saw is about 60% of all builders are not only buying down the mortgage rates, but also some sort of incentives, right? Some upgrades in the design center, that sort of thing. So it's interesting to keep an eye on both of those, recognizing that sometimes the new home can be maybe the right way to go when it comes to the fact that they can work on skinnier margins just to keep.
Hey, Dennis, it's even a place for investors to look today.
Yeah,
that's crazy. But if you're looking for a single family rental property, as long as that home is in a development that doesn't have HOA rules prohibiting rent,
right?
In a lot of cases, those new homes are better deals. To your point, we're seeing mortgage rate buy downs. We are seeing concessions, either in terms of upgrades or price concessions. But the builders are actually doing a pretty good job on paper of keeping prices where they are.
Right. That's their goal. That's why the incentives, right? Keep the pricing.
But it's even weirder than you pointed out. If you look at April sales numbers, the median sales price of a new home was $407,000. The median price of an existing home, a resale, was $414,000.
Oh my
So
God.
it's actually flipped.
Even
Now,
more
keep
extreme.
in mind that the builders are selling more in lower priced markets. So there's a little bit of a product mix that goes into those numbers.
Gotcha. Interesting.
But still, I've never seen the margins compress like that before.
And there's another point I'd like to throw in there, because I know we have people with an investment mindset, and I'm so glad you brought that up. But to also recognize that many builders now have had quite a few years they've played in that SFR market, and
Single family rental.
Well as multifamily. Pardon?
You gotta explain SFR, because SFR is single family rental. Yeah, single family. SFR for some people, single family residence, and they're the same thing. It's just a single family rental.
As opposed to a zoning designation, right? Exactly. I'm sorry. Yeah. So single family rentals as well as multifamily rentals. But the point is, as an investor, if you had an opportunity, something to explore would be to get together with a builder who has that rental property spec. They've designed the homes. They've got the specs as far as the finishes, the materials, and so on, and see if it's possible to contract with a builder to build something, or to buy off of actual inventory that they're building for rental purposes, and maybe take advantage of that, get a little bit lower cost per unit, but something that's specifically designed to appeal to renters, maximize that return.
The hedge funds will do that before we get a chance, but maybe in more remote areas you'll be able to do that. So, all right, so I love hearing that insight, and I love hearing where you guys have been. My quick version is basically went to buy my first home in 2005, and the mortgage officer told me how much I had to write on the application for my income, not the other way around. Like, he didn't ask me how much I made. He told me I had to put down a certain number. And then he said, we have to make it believable because you're a certain age. We don't want it to be too high. But if you're just making up numbers, like what's believable, what isn't? So that was a big red flag. And then when I ran the numbers with my wife, and we were so excited to buy our first home because we saw all our friends doing it, we ran the numbers and we realized we'd run out of money in a year of owning the home. And of course you would just refi, right? Because the values would continue to go up. That's what everybody said. But to my wife's credit, she realized, hey, this is a big mistake. So we didn't buy. And finally we bought about 3.5 years ago. And we actually sold that house. And that'll be a separate discussion about why we sold, because we had a huge run up in values, and we decided that was good timing to take some profit. But Eccentric has a good point here, and it's a succinct point, and his market is headed down, and he's right. But what I think gets convoluted by some folks and conflated is the market heading down. Yes, we just talked about the fact that the median home price is down in some areas year over year. But to Rick's point, this isn't going to be a 20, 30, 40% drop. Now, there could be a black swan event outside of the real estate market. There isn't anything built in within the real estate market like we had in the global financial crisis. In that time, that was a built-in black swan that basically occurred. There could be an outside black swan, but when you have an outside black swan, then there's bigger issues about maybe home values are down 30%, but everybody's income is down 100%. I mean, there could be bigger issues with the black swan. So the other thing
we had a black swan event in
COVID. Yeah, COVID,
exactly. I was speaking to a group on September 11th, 2019, and I mentioned that the economy was hitting on all cylinders. The housing market was red hot. Nothing short of some sort of unexpected global catastrophe could knock us off track. And you could almost hear somebody biting into a bat in Wuhan when I said that. But Eccentric makes a good point about 18-year housing cycles, and there's some truth to that. We've seen these cycles before.
It was it was a 7-year cycle, by the way, before I started hearing about the 18-year cycle.
Yeah, and that's more like what most economists will follow, is that 7-year cycle. But what I would point out, what I would submit anyway, is that I do believe that last black swan event has thrown the cycle the cycle's completely off track.
Mhm.
That whiplash that we went through with low mortgage rates, high prices, doubling mortgage rates during a period where the economy was actually doing better than most people expected. $15 trillion of government funds poured into the economy to kind of backstop things. We're dealing with unknown circumstances,
Sure.
with things we've never been through before. And I think there's a bit of a hangover that the market is suffering because of that. I do think we need things to happen to get affordability more reasonable. And it probably is some combination of mortgage rates eventually coming down a bit, wages continuing to go, and prices coming down a bit as well.
Yeah, this
Yeah,
is
and
from
go ahead.
YouTube. His name's YouTube backwards, so I'm not even going to try to
Oh,
pronounce it.
that's good.
That's clever, isn't it? I
Yeah.
noticed that he's commented on some other videos, so I typically answer his comments backwards, but that's a whole other story. So it's and all this is caused by because of 7% rates. That is true. The slowdown we're seeing. I will tell you, in the buyer demand I have tracked in Southern California, it has been, and by buyer demand I mean pending sales, because I run all these numbers straight out of the MLS. It has been very flat for the past 3 years. We haven't it took a dive because of 7% interest rates, but it has just been, to me, it's a minimum of buyer demand that we're seeing. And unless rates somehow magically spike even higher.
But every time we see rates come down even a little bit, you see a surge of buyer activity. When we got down to, I guess it was 6.5% a couple months ago, you saw people crawling out of the woodwork. You saw pending sales go up. You saw mortgage loan applications go up. All of those predictive indexes that you look at jumped. So, and the other thing I'd point out is that 7% rate. So I don't disagree with YouTube, by the way, that 7% rate was an inflection point. When that hit, we also saw, people not listing properties anymore.
Exactly.
And we're starting to see that recover, which is one of the reasons the prices are slowing down. There's just more inventory to choose from.
Yeah, it was crazy because the main tool they have is, let's go ahead and increase the interest rates, and that's going to control inflation. And then what is it? Everybody's frozen in their homes. Inventory is reduced. Home prices start to inflate like crazy. It's just insanity. And Christian, your point about it being a flat line, other than Rick's, those measurable jumps when there's a little bit of activity. And it's interesting because that activity occurs, Rick, you can probably remember, whether the interest rates jumps a little bit or drops a little bit. We used to often see a jump in the market. Some people trying to catch it before it ran away, and others taking advantage of it. But when you look at the fact that we continue to have households grow across the country, and we're at a $4 million or 4 million home a year, sales, that's a low flat line right there. I mean,
well, yeah, we're selling as many properties now as we did 30 years ago.
Exactly.
And we have 74 million people. So that's not a good metric.
No.
We basically have just about 7 more minutes because I want to be cognizant of your time as well. But I wanted to pull up some of these fancy charts like PD said. So
I love them.
We got these back up. List prices are flat. Price cuts continue to rise. What I'd like to say about price cuts and comparing to years past, pre-COVID, I feel like on some level, sellers are quicker to drop their price. There's more, it's like easier to run the numbers now. There's more data and we've just come through a market where if you didn't sell in 2 weeks, there's something wrong with your home. So if you're on the market for 30 days as a seller, I feel like part of the reason price cuts have risen so quickly is sellers are actually being more realistic. But anyway,
days on market is up too. Nationally, it's taking about 50 days to sell a property. California, we're still in the 20s, but places like Chicago, you're seeing 80 days on market. Denver is pretty close to that as well. So the longer on the market, the more willing that homeowner is to capitulate a little bit on pricing. But also keep these in context. You're not talking about 10, 20% price cuts. You're talking about 2%, 3%, 5%. Right. So it's meaningful, but it's not huge.
Good point.
Yeah. And this is, so we're on the days on market continues to increase chart. What's helpful with this to see as well is that it's flat in the middle of numbers between 2017 and 2025 for days on market. So
Yep.
we're not at record high days on market. We're right in the middle. So, and
We're getting back to
2017,
normal, actually.
exactly, 2017 through 2019 being normal markets. So, but talk about buyers markets, Rick.
Yeah, I do think, and this is something I think all of our the people that have chatted with us today would probably agree, is we're coming out of one of the strongest sellers markets we've ever seen for a number of years. And sellers markets typically have fast rising prices, low inventory, and short days on market. And we're seeing all three of those kind of reversing course. If you look at the map on the right-hand side of this slide, all those areas that are light blue are already kind of buyers markets where days on markets are longer, prices are flattening or declining year over year. The other markets, Northeast, Midwest, parts of the West Coast, still kind of tilt towards sellers. So nationally, on average, still a little bit oriented towards sellers, really close to a neutral market. But as that inventory continues to increase, days on markets increase, we'll see prices come down even further. And it really will be a more buyer-friendly market most places across the country.
Oh, interesting.
Okay, so we're getting down to our last few minutes here. PD, I want you to give advice to people right now. Anybody, buyers, sellers, give me 1 minute of advice for our listeners. Is that a good enough setup?
Geez, I don't know. Would have been nice to have prepped that question, for a moment. Well, I don't know. You're talking about buyers and sellers. You're talking about just folks out there looking to buy a home, and
that just your thoughts on the market. And I know what we talk about. We talk about the fact that remodeling is a big deal, and people should consider that whether they're looking to sell their home or buy a home. Remodeling is
let me just touch on that briefly. Look,
talk about that.
Yeah, let's just talk briefly. Look, we've got an aging housing inventory, right? 80% of the homes in America are 20, 25 years old or older. They're going to get older every year. This is going to continue. Affordability is going to continue to be an issue. We can't just, we really still, in spite of everything that's going on here, there's still studies that are going to say that if we took household demand and really fulfilled it, we'd need another 3, 4, maybe 5 million units to do that. So there's still a long runway and need there. If you're trying to get into home ownership, I'd say, to your point, Christian, as you know, we have training all around remodeling. We have our remodeling value analysis concept. We work with real estate professionals. We work with homeowners, helping them analyze this, investors. The point is, don't overlook the ability to find properties where you can find greater value because they're not pretty. They're not move-in ready. Don't go blindly into improvements in your own home, or, as you look at purchasing a home, do some analysis. Talk to some qualified real estate professionals to get a sense of how those improvements are truly going to impact the value of your home. Now, some people will say, I want to make sure I don't make any improvements that I can't recover. Or some flippers, of course, will say, I want to make just strategic improvements that I'm going to recover and generate some sort of a return. Flippers, I think, Rick, you probably have numbers, but on the average, about a 30% margin or less on the flipping. Then there's folks out there who say, I don't care. You can bury me in the basement or the garage. I'm going to improve my home the way I want it for my value. But I think if more people think along those lines, maybe don't have an instant gratification attitude when it comes to purchasing a home, be willing to put some of the hard work into it, you might find some value out there. And I think the last thing I'll say is that there always seems to be an opportunity, almost always seems to be the right time for someone based on where they are and where they are financially, where they are geographically, and so on, for them to be moving into home ownership. So that's that.
Well said. 2 things I'll add to that is, one is it's amazing to me the number of clients who say, I'm willing to do some work on the home I'm going to buy. And then we proceed to only look at turnkey homes. So don't be afraid to do work. They only look at turnkey because that's all they want. They get scared. And then 2, Do not bury yourself in your garage or basement. That will affect your home value. Okay. So, Rick, I actually pulled some quotes from the last time we chatted, which was a long time ago. And this is a quote I want you to basically add on to and give your thoughts on where things are headed. So you said, novel ideas on how to create the next crisis. We haven't found that novel idea just yet. So that dovetails into what you were saying earlier. But so we obviously need to be worried that there's maybe going to be some sort of crisis at some point in time. Are you worried about it now? So please expound wisely on this.
No, I think you characterized it perfectly earlier, Christian, when you said, what could really turn this market into a mess would have to be some sort of black swan event. If we had an unexpectedly severe economic downturn or recession, if there was some sort of global war, God forbid. So it'd be some sort of exigent factor that would be coming in to disrupt the fundamentals of the U.S. economy, let alone the housing market. So I really think the most likely scenario, and this is boring, but is we kind of wade through the muck for another year and a half. We see home prices get a little bit more affordable. We see the economy settle down a bit, which tends to lead to lower mortgage rates. But we continue to see a strong jobs market. It's been very resilient. Wages continue to go up. And so the affordability quotient starts to improve. We've also seen builders shift gears a little bit. They're building smaller, less expensive properties right now. And so market conditions gradually improve, and people that have been on the sidelines have a chance to come in. What I would say to people thinking about the pros and cons of home ownership is if you're looking at things with a long-term perspective, you're going to buy someplace, set down your roots, look at it as a place to raise your family. For most families, home ownership is still the best financial decision in the long run. But there are short-term considerations. Right now, it's cheaper to rent than it is to own in just about every market in the country. And in some markets, it's considerably cheaper to rent than it is to own. So don't feel like you have to rush into market. But if you find a property that you believe you can afford financially, comfortably, don't wait for the market to crash. Don't wait for mortgage rates to come down. Odds are prices are going to go up by the next time you think you're going to buy something. So move quickly, but not injudiciously. Really think through what you're going to do, but don't hesitate to buy because you're expecting a market crash anytime soon.
Love it. I really appreciate your time, gentlemen, your perspective, everything you've shared. And I'd like to do this again because there's so much we didn't cover. We didn't even get into foreclosure data and all the untapped equity. Like there's just so much more I want to chit chat about. So
I do have some great war stories too. So you know that.
Yeah, I know. More stories. Exactly. This is what's good. Why I love talking to wise folks who've been through several real estate cycles. Go ahead and read between the lines on what I'm really saying there.
Old guys.
All right. Thank you, gentlemen, very much. I appreciate it. That is the end of this one, but the beginning of more fun to come with you guys ahead. So thank you.
Okay.